Welcome, Mr. Vora. Let's start by talking about your NFO, which is going to be a flexi-cap fund. Can you tell us why you're starting? This is also going to be your first equity NFO at Trust Mutual Fund. So why are you starting with a flexi-cap fund in the first place?
Hi Nikhil, thanks for having me here. FlexiCap is in some ways a natural way to start the equity offering because first of all it's the largest category amongst the equity funds in the mutual fund space. So it being our first offering, we cannot not be there in this space that because it's the largest space. But more importantly, given the current conditions in the market and given the fact that we are bullish on the growth prospects in India, we see opportunities across market cap buckets. We see opportunities across different sectors. And we also have observed that no one style or market cap bucket or sector is a leader every year or every quarter. These things keep on changing. So it's in a country like India, it's kind of good to have the option of picking and choosing from sectors, market cap buckets, as well as styles, because you never know which style and which sector is now evolving as a faster growing segment. And most importantly, what we have realized is that ultimately stock picking makes a lot of difference. It's the whole difference is in stock picking, because even if you look at the shorter term in any given year, we did a study of some of the popular indices. So if I were to give you an example of the NSE 100 and look at the performance of the top 10 stocks out of those hundreds in a given year and the bottom 10 stocks out of the given 100 in a year, the difference is huge. For example, last year, while the Nifty 100 was up only 10%, calendar 2023, the top 10 stocks average returns was 100%. Okay, and the bottom 10 stocks average was probably minus 20%. So even within the index, the scope for stock picking is huge. So we believe it's a logical enabling style or mandate for the fund manager to pick and choose across the spectrum of stocks, because in our view there are about 900 stocks which we can consider in the investable universe.
The fund document also talks about something called gorilla companies and the terminal value investing. What is that? What is it? Can you take us through the concepts?
So as I mentioned, Nikhil, at heart, we are growth investors. Okay, but growth investors with a very close view and very close watch on valuations. So I like to call ourselves GARV investors, growth at reasonable valuations. And I'm deliberately not using the term price, GARP, which is the more popular term, because in many senses, price denotes some element of maybe cheapness that is required. But we are not looking at cheapness for the sake of it. We want to value a company properly based on its future profitability and profitability growth, arrive at a value of those future profits and do a proper valuation. We are not starting with the fact that it should be cheap by the traditional standards, say P by E or P by B or high dividend yield, etc. That's not a starting point for us. For us, what matters is the value of the company based on the future profit streams. So GARV is our basic style, growth at reasonable valuations. But even within GARV, our wish, or I would say our North Star, is what we call terminal value investing. And I'll just spend a couple of minutes on that. In high growth stocks and sectors, right, typically what happens is that we tend to underestimate the runway of growth and the quantity of growth as well as the longevity of growth. We tend to underestimate both. And that makes a huge difference to what the potential value or valuation of the company should be. Okay. If you look at any research report, for example, typically even in a high growth segment, we would say that yes, the stock has grown 30% for the last 3-4 years. It's a very high growth stock. So maybe it'll continue to grow at 30-35%. And that you arrive at after meeting the company, looking at the business plans, the transcripts and the momentum that is seeing in the business. You would typically tend to extrapolate for the next 2 to 3 years. So let's say 30-35% growth for the next few years. Then typically you would taper it down to say 20-25%, then 15-20%, and then maybe 10%. And typically beyond 10 years, it's very difficult to predict. And so it's not comfort zone to predict beyond the medium term, so to say. So we typically then tend to taper it off to say a nominal terminal growth rate of 5% or 7%. That's a typical model that you see all the time, right? Nobody is willing to or comfortable predicting for the longer term. What happens is that in high growth stocks and sectors, even beyond the first 5-10 years, the growth continues and in some cases even accelerates, right? So the value or valuation that you should have given to the company today should have been much higher than the value that would have been valuation that would have been thrown out by the typical valuation model that I just described. 30%, 25%, 15%, and then a nominal terminal growth rate. The difference between the valuations, if you take the actual growth rate, and we've seen in sector after sector, stock after stock in India, the terminal growth rate or the growth rate beyond the 10th year is not 5% or 7%. It continued at 15%, 20%, even 25% in a lot of cases. So the valuation difference can be almost 3 to 5 times. If you use a traditional model, and if you use the terminal value concept, the valuation difference so almost 70, 80, 90% of the terminal value in some cases can come from the profits beyond the 10th year. Okay, so getting a hang of the value of the company for the profits beyond the terminal time period, which is beyond the forecast period of typically 10 years, getting a hang of that terminal value, which is the value of the cash flows beyond the 10th year, is called terminal value investing. And the reason why we gave the analogy of a gorilla, you asked about the gorilla because our logo, shows gorilla, is that, if you were to look at the jungle, there are many kinds of monkeys, right? But gorillas are the rarest. Okay, you need to go deeper into the jungle to find a gorilla, so they are rare. But they are large and dominant, and they are unchallenged. Okay, no, the other monkeys or other animals don't mess around with gorillas because they are large and dominant in their jungle. But most importantly, gorillas have the longest life amongst all the monkeys. Okay, so in terminal value investing, what matters is the longevity of growth, the runway of the growth. And that's where gorilla makes a perfect analogy, because if you have a long runway of growth, like the long living gorillas, you will become large and dominant in your sector or segment, right? But as you know, such companies are rare to find. So gorilla that way fits in perfectly with the analogy of the high terminal value companies that we are trying to find, because such companies are rare, they become dominant, and they have a long longevity of their growth rate path. So that's where the analogy of a gorilla.
So you're going to pick the existing gorillas, or you're going to pick the ones that are going to become gorillas in the future? Both.
And it's a very good question that you asked, because typically when you talk about high growth and, multi-baggers, etc., you end up in your mind conjecturing that it's in the micro cap segment or only small cap segment. And we have a very good NFO presentation which is publicly circulated. We have given many examples in that presentation. Companies don't have to be, micro cap or small cap to be such gorillas or multi-baggers for a long period of time. They can come from existing, mid caps or even in large caps in many cases. In our examples, we've shown there are companies which were already very well established in 2005, 2006. But the stock price went up by 60 times, even though they were already good brand names at that point in time. In consumer discretionary sales, jewelry company, one of the largest jewelry company. We talked about one of the largest private sector banks, one of the largest FMCG companies, which were already very well established brands even in 2005, 2006. But those stocks became 20x, 30x, 40x from there to now. So it doesn't have to be a new company or a micro cap. Gorillas and potential gorillas can come across the market cap.
That's a very interesting point that you made, Mr. Vora. We have seen how big companies are becoming bigger, and I think that trend has accelerated post-COVID. But as far as our retail investors are concerned here, they are obsessed with small caps, micro caps, and SMEs. And there's a lot of talk about all the froth. So what do you think, and most of the froth that we're talking about is in the small cap, mid cap, and even SME stocks for that matter, and they are all linked to the domestic economy, which is booming. There's no doubt about it. So do you think retail investors should actually be worried about fraud, or there are enough gorillas hiding in that space?
So as I said, there are gorillas across the board, right? You just can't not do due diligence on your investments. So ultimately, you have to do your due diligence. The Roman phrase or the Latin phrase for it is caveat emptor. So buyer always has to be careful. It's always the responsibility of the buyer to check on the goods that he's buying, right? So I mean, there are, as I said, we just did a cursory survey of the market, and as an institution, as a potentially large institution, we want to be in stocks at least where there is some amount of familiarity, some relevance. So as an arbitrary cutoff, if we look at about 2,000 crores as the market cap cutoff for December 2023, for which we have the AMFI data of companies, there are about 942 companies which have a market cap of more than 2,000 crores. Okay, so and coincidentally, I also looked at all the companies which are owned by any kind of a mutual fund, at least one or two mutual funds. That list is also around, it could be in any scheme, but that list is also around 900 stocks. So I think there is an investable universe of around 900 to 1,000 stocks in my view. And the froth, the worst of the froth probably was in the segments below that cutoff. The micro caps, as you mentioned, the SME segment that you mentioned. So yes, there was excesses out there, but my guess is that with the kind of surveillance mechanisms etc. happening, T4 they put additional margins, the circuit filters are lesser, and then there is also moving stocks into a trade for trade segment. All those mechanisms are also kicking up, right? So in my view, there is froth, but that does not mean that there is no scope for stock selection or the whole market is overvalued. I don't believe that. But if I were to make a general statement, the top 100 stocks, which are the large caps, I don't feel reasonables are frothy. I think valuations are frothy. I think the valuations are still reasonable. Then comes the next 150 stocks, and then the stocks beyond the 250th stock, which is the small and micro cap segment. So what I think is that, as we mentioned, that probably there are about 900 or 950 stocks. So I don't see too much of a problem in the first 100, which is the large caps. I think there are enough stock picking opportunities, and not everything in the small cap segment, which is 250 and below, which are another 750 stocks. I don't see that you can't pick stock. There is enough scope for stock selection. Not everything is expensive. As an aggregate, I think the middle 150 is probably a little more expensive because I think a lot of money is perforce going into those 150 stocks because of the definitions. So in general, but again, it's not like there is no scope for stock selection within those 150. But if I were to kind of generalize, crudely speaking, I don't see too much of a bucket in the large. There are enough scope for stock picking in the small. Middle is where a little more, a bit of distortion in the valuations is there, I would say.
Fair point. So at this stage, what should be the ideal asset allocation strategy for someone who has a moderate risk profile? Or just to give you an example, if I have rupees 10 lakh to invest, how should I divide it between equity, debt, or maybe gold as well?
Okay. So Nikhil, asset allocation ultimately is a function of one's own unique position, because not everybody has the same financial aspirations, current net worth, socio-economic liabilities like marriage, of education, number of dependent parents, etc. So, the risk appetite basically is a function of a lot of things, stage in life, current age, etc. So I won't try to give a prescriptive answer on this, but I'll kind of give you my view on each of the asset classes, which is equity, fixed income, and gold. Say 3 years ago or 4 years ago, if you were to ask me when the markets had crashed and there was so much uncertainty, valuations had come down a lot, and the central banks were cutting interest rates dramatically. So at that point in time, because of the sharp crash in equities, I would have definitely recommended a lot more allocation to equities, right? Now we have, of course, the market has done very well, but for India at least, I can see very good growth even in the coming years. So I'm bullish on equities for sure. But on the other hand, RBI has been hiking rates, right? So fixed income yields have become also attractive. And now we believe in the next 1 year or so, we should actually see long-term bond yields starting to come down. So when you have the 10-year bond at 7.10 and the scope of rate cutting, probably there's a chance of making 8% or 10% on the fixed income piece in the next 12 to 18 months annualized, right? So to that extent, you can see some good returns on the fixed income segment also. So relatively speaking, compared to 2 or 3 years ago, I would say a little more skewed towards fixed income with a continuing bullish view on equities. But in equities, the kind of 20-25% CAGR that we made in the last few years is not going to happen. We should be happy if we can make 10 to 15%. Gold is something I am still positive on, I would say. And that's more because of the fact that surprisingly, the US especially has been more profligate on the fiscal side, right? So there is a chance that inflation out there may be longer lasting than expected. And you do see that when inflation expectations go high, you will see people flock towards assets like gold. So maybe 5, 10, 15% asset allocation to gold also can be considered.
So we are also in a unique position where, the equity is at an all-time high, gold is at an all-time high, even Bitcoin is at a record high, and interest rates aren't going down. So what's causing this everything rally? Is it liquidity? Is it growth aspects?
Actually, as I mentioned, it's absolutely the surprising profligacy of the not the Federal Reserve, but the profligacy of the US government. If you go back 1 year, what were the expectations, right? Expectations were we are past the COVID and a monetary easing has peaked out and monetary tightening will start, which will lead to a slowdown in growth, right? Because especially in the Western world, there is a reasonable correlation between rising interest rates and slowing down of growth. So 1 year ago, for 2023, the expectation was that US GDP will grow by 0.5%. We ended up at 2.5%. US GDP growth for 2023 ended up at 2.5%. And why is that? The first thing happened, which is the monetary tightening, the rise in interest rates happened. Okay. And the expectation was that along with that, even fiscal deficit will be reduced because you don't need extra stimulus when the corona crisis is gone, because they had already stimulated so much that the US is anyway at a record high level in terms of debt, etc. So the expectation was monetary and fiscal tightening will happen. But monetary tightening happened, fiscal tightening did not happen. In fact, they let the fiscal deficit run. So the demand and growth came out stronger than expected. And so did inflation. So we are in a situation where growth is high, but inflation is also high. And as we discussed, when inflation expectations run high, you will see other asset classes appreciate, like gold and Bitcoin, because people are desperately trying to find a hedge for inflation.
Your FlexiCap fund also intends to invest up to 10% in REITs and InvITs. What is the kind of potential that you see in these two emerging investment avenues, especially in the commercial real estate space?
So we are not planning to aggressively invest in these asset classes. This is more of an enabling, clause. If we find something really attractive at some point in time, idea is to invest in equities only, because ultimately we do believe that there is enough scope for stock picking within equities. But I do like REITs and InvITs as an asset class, but more for the yield part. So I would buy REITs and InvITs if yields become suddenly very attractive, because then we would see yield compression and capital appreciation. So I buy REITs and InvITs only if I see stable yields, high stable yields, or yields have gone up so much that there can be scope for capital appreciation. I would not buy REITs and InvITs for the growth aspect, capital appreciation, just because they are available at a certain yield. You have to either have a very good current yield, which would then give you capital appreciation because of yield compression. That's the way to look at it for me.
What is the threshold for the yield part that you're talking about, like 10%, somewhere in double digits?
No, really, because I don't think because it's a new asset class, there is shortage of supply. So if the current yield is anywhere around 8%, that should be good enough, because we do see a lot of HNIs and family offices become interested at those levels. So I don't think yields go down too much below 8%. Sorry, we don't see yields go up more than 8% because of interest coming out, unless there's a big crash. So if there's a big crash, then of course prices go down and the yield becomes attractive. But typically at around 8% or so, HNIs, family offices come into the picture.
How much of growth do you think is left in our FY24 favorite stocks like Rail, Defense and PSU banks as we step into FY25?
So I think I would say that all three are, as you pick the highest growth sectors, I guess. Uh, but let's look at them one by one. Banks, of course, have underperformed except PSU banks. So while PSU banks have done well in the last 12 months or so, private sector banks have sort of underperformed. So the banking index per se has underperformed. I think it came after after a lot of outperformance in 2020-21. So there was so much outperformance that probably there was some kind of a time correction. Second is that if we expect the economy to grow at 6.5-7%, then the banking sector will tend to outperform. We have seen that in growth times, banking sector does well because credit growth is typically 1.3-1.4 times the GDP. So in a good market, banks should do well. And given that they've already underperformed for the last 1 year or so, I think the risk return reward is quite favorable towards banks outperforming. On defense, I am actually quite bullish even in the long term. So while stocks have run up in the last year and they have been favorites, I think given that the government is very serious on more indigenous production and private sector has stepped in now with exports also. If you look at the indigenous production and consumption potential and add to it the export potential, the runway can be really long. And as we talked in the terminal value investing, what we look for is the longevity of the runway or the length of the runway. And I think in defense, given that for the first time we are opening up the export potential, that runway can be quite long. Railway again. The government is spending, but probably because of the intensity of ordering, stocks have become a little bit, euphoric. So while I do see a longer term path to runway, relatively speaking, I would say defense and banks look a little better.
In defense, I think much of the market's attention has been towards domestic demand, but probably we will see the export-oriented domestic defense companies going up in FY25 and further on. What do you think?
No, but not only the private sector, even the public sector is being encouraged to start exports. So it'll be across private and public sector companies.
One last question, Mr. Vora, before we end this conversation. Which are the broader sectors that you would be, broadly bullish on as we step into the new year?
So basically, we think that there are 7 drivers for India's growth, and from those 7 drivers, there are 3 themes or 3 subsectors or sub-themes that we get bullish on for the long term, right? So these 7 drivers are, 3 of which are old, and I would say 4 are relatively new. So the first 3 which are old is democracy, demographics, and deregulation, right? So all these 3 have been around for a long time. Deregulation came in 1991, since we began the reform process of delicensing, removing quotas for industries, reducing import duties, reducing excise duties, reducing corporate tax. All those deregulation and reforms have started, and they have broadly continued in the right direction. We are seeing more competition and India opening up more to the global economy. So democracy, demographics, and deregulation were there to start with. But the 4 other Ds out of the 7 Ds have come up relatively recently. The first one is diversification of manufacturing away from China, right? So whether it's US or Europe, most multinational companies are looking at other countries, including India, as an export base. And given that we have the largest pool of labor in the world, and demographically, the labor pools in China, US, Japan, Europe are shrinking, leaves us with a natural advantage here. So this is come up in the last 10 years, where you saw that China's population, by the way, has already peaked in 2020. So it's already on the decline, and you can see that in the competitiveness, no more disinflation, etc. So diversification of manufacturing away from China is a big theme. Second is digitization. Our Aadhaar, UPI, Jandhan mobile combination helps us deliver the lowest cost financial services in the world. So whether it's opening a bank account or demat account or a broking account, government services, subsidies, going at cheap cost to hundreds of crores of people, it's unique in the world. And that's getting a lot of people into the formal, financialization fold, so to say. Panwala, for example, earlier did not have a track record of his bank account because everything was in cash. But now a lot of the transactions are through UPI. So we are able to see in a bank of NBFC can see his income streams. So he suddenly becomes eligible for a loan. So this digitization and new business models are coming up, disrupting the existing businesses. So digitization is another trend that we are talking about. The third is, I would say, debt, which is we are amongst the least leveraged countries in the world at the country level, at the corporate level, as well as the household level. So while debt has increased, we are far below the global averages in most of the cases. So if we have to grow, which we are growing, we have enough capacity to take on domestic as well as global debt to grow. Okay. And fourth, out of the 4 new Ds is dynamism, which is the unleashing of entrepreneurial spirit in India. 10-15 years ago also, there was no risk capital available. There was no local venture capital, very little local private equity capital available for ideas. Right now, a young engineer, whether it's IIT or in the college, if he has an idea and he wants 50 lakhs, 1 crore, 2 crore, there are people who will fund that. So this ecosystem of rich individuals, angel networks, VC funding locally available, HNI family offices is willing to give capital for risk. And that is changing the mindset. That is unleashing a lot of innovation and creativity and changing the mindset of the younger generation. So diversification of manufacturing away from China, debt, digitization, and dynamism, which is the entrepreneurial spirit. These 4 Ds are the newer ones. So we think that these are very long-term drivers for India. And based on these drivers, what we like is premiumization of consumption. So consumption is good, but premium categories will grow faster for a long period of time. So that's one. Financialization of savings. Again, everything linked to capital markets and financial, like the banking, NBFC, asset management, insurance, broking, wealth management, all those segments will grow much faster than the rest of the economy because of the demographics that we are talking about, higher migration of people. Second big theme we are talking about is physical asset creation. Government wants us to grow at 7-8% for a long period of time, but we have seen again and again, no country in the world has had high growth phases without creating physical assets, whether it's manufacturing capacity, whether it's infrastructure to support that, or whether it's real estate. So physical asset creation is a big thing without which I'm very sure we cannot grow at 7%. We'll probably grow at only 5 to 5.5%. We cannot continue to grow just on consumption and services. It has to come from manufacturing and infrastructure. So that's again a big thing that the government is also aware of. All these PLI schemes, etc., basically to make sure we make more in India and create the 1 crore jobs that are required every year, to keep people employed, because we are adding almost 80 lakhs to 1 crore people to the working age population every year. So we need all of this to come together to create those jobs, because IT services cannot create crores of jobs. They can create a few lakh jobs every year. Not enough. We need jobs in physical asset, manufacturing, workers, etc. So that's another big thing we talk about. So we talked about consumption and financialization of savings. We talked about physical asset creation. And third, we talked about digitization and the technological disruption models. So, there are so many models which did not exist 10 years ago, which are now, becoming large. All these fintech companies, all these online B2C companies, a lot of which also got listed. So those models were probably not possible 10-15 years ago. And we do see that there is a lot of, creative disruption happening in this space. A lot of companies have already gotten listed in this technological disruption space, but a lot more to come. So that's another very exciting sector that we believe for the next few years will be driving the markets.
Thanks a lot, Mr. Vora, and wish you all the best for your maiden NFO in the equity space.
Thank you so much. Always a pleasure.